This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're looking at the first of the two chapters on interest rate risk management. And in this lecture, we're going to look at interest rate futures. Now, in one way, there is a similarity to foreign exchange futures in that we're using one risk to cancel another risk. That, the interest rate that will be charged on the loan may be higher or may be lower. We're going to deal in futures just as we did with foreign exchange, but the futures will either make a gain or a loss, and we're using the gain or loss on the futures to cancel out what you might call the gain or the loss on the interest rate itself, on the loan interest. So I don't need to go through all that side of it again, but there are a couple of huge differences in that. Firstly, there are futures, what we call interest rate futures, quoted on the exchanges, but they're not actually quoted as an interest rate. What happens is if the interest was, say, 10%, the equivalent futures price, well, it's quoted as a number, and it's always quoted as 100 minus the interest rate. So 100 minus 10, the futures would be quoted as 90. And these are quoted to two decimal places always. And if the interest rate was, let's say 12%, the futures price, the futures that we're going to deal in, the price quoted would be 100 minus 12, which is 88. If the interest rate was 6.25%, well, the equivalent futures price, 100 minus 6.25, would be 93.75. And so that in itself isn't hard, but as interest rates go up and down, the futures prices change, and to cancel the risk on the interest rate, we will buy and sell futures, like we were doing before. And, depending on whether the price has gone up or down of the futures, we'll make a profit or a loss. Secondly, though, directly from that, suppose the interest rate today was 10% and later went up to 12. Well, assuming we're borrowing money, we'll be paying extra higher interest. Today's 10, the start of the loan, it's 12. So, on the interest itself, we'll end up obviously paying more. We'd want the futures to make a compensating profit. Well, the prices of the futures today would be 90. At the start of the loan would be 88. Well, you buy and sell at 90, at 88, at 93.75 and so on. But since we're losing on the interest, we're paying more interest, how can we make a profit on the futures? How can you make a profit if the price today is 90 and the price later is 88? Well, the way you make a profit on the futures price falling is surely you sell today. If I sell today at 90, and then at the start of the loan, I buy back at 88, then I've made a profit of 2, which is equivalent to 2%, which cancels out the extra 2% I've had to pay on the interest. And so because futures prices are moving in the opposite way to interest rates, if you're borrowing money, if you're borrowing It worries you if interest rates go up. How do you make a profit on futures if interest rates go up? If you're borrowing, you will sell futures now and buy back later. I've already made the point in earlier lectures that with these sorts of things, you can do it in either order. You can either buy now and sell later, or you can sell now and buy later, because with futures we only settle up at the end of the deal. But if you're borrowing money, you always will sell futures. And if the interest rates go up, the futures price goes down. You buy back at the lower price and you've made a profit. I should hardly need write, but although less common in the exam, if you're depositing money, then clearly you're earning interest, so you're worried if the interest rate goes down. Well, if the interest rate goes down, if it went down from 10 to 6.25, the futures price would go up from 90 to 93.75. How would you make a profit on the futures to cancel the loss on the interest? You would buy futures now and sell later. You do have the case in the exam sometimes when you are depositing, usually taking a loan, but I would have made that clear. So that's one thing that's different, and we'll put it all together in an example shortly. But the other thing that's a bit different is how we calculate the profit or loss on futures. It should have made sense there that if we're borrowing in that little example, we'll sell at 90 and buy at 88, and the profit is the difference of 2. But always in the exam, they're what we call 3-month futures. And what it means when it says 3-month futures, it's talking about how we calculate the profit or loss. Suppose I told you, my example there, that we're selling futures at 90 and then we're buying at 88. Now fine, we've made a profit of 2, and that is equivalent to 2% interest. Remember, interest rates are always quoted per year, and if the interest rate has gone up by 2%, the futures price will go down by 2. Effectively, it's 2%. But when we calculate the profit, we say, well, it's the amount of the futures, maybe it was 100,000, let's say. But when we calculate the profit, we do look at the difference and say, the profit is 90 minus 88, 2. That's equivalent to 2%. Oh, I made that clear. And so we divide by 100, it'll give us 2% profit. However, it's always calculated, because they're 3-month futures, it's always calculated as though it's for 3 months, a quarter of a year. And so 2 over 100 would be the profit on an annual basis. We calculate it as though it's for 3 months. For 3 months, out of 12, we divide by 4. We always divide by 400. It's always divided by 400. And the reason is not that the reason matters so much in the exam, it just has to be automatic. The reason is you're calculating it as a percent for 3 months. A quarter of a year, 3/12. Now, it's always 200, and that's the only relevance when you're told it's 3-month futures. It's nothing to do with how long the loan's for. I don't care if the loan is for 1 month, 12 months. We'll sort out all that side of it later. But the profit on the futures is always the difference between the sell and the buy prices divided by 400. Now that creates an extra problem in a moment, which I'll show you with an example. But otherwise, there are the two big differences from foreign exchange futures. The profit, well, the idea, the way they quoted, that it's always 100 minus the interest rate, and the fact that when we come to work out the profit, we always take the difference between sell and buy, we always divide by 400 for the reasons I've explained. Well, now let me show you how it works, and just the one extra problem that creates. Firstly, with a very basic example, and then a bit like I did on foreign exchange futures. Basic example first, and then I'll show a more exam standard and practical one with the extra problems in. Look at example 3 with me. Today is the 3rd of October, and today interest rates are 8% per annum. And of course today's interest rate fairly irrelevant, because when we come to take the loan, we'll pay whatever the interest happens to be. And we are going to borrow 6 million for 6 months. Starting on the 1st of January. I said a minute ago, as I said all the way through, by the 1st of January, they could be quoting any rate. It might be 10%, it might be 4%, it could be anything. There are 3-month January interest rate futures available, and today's price is 92. And so, today, the interest rate is 8%. The futures price, well, 100 minus 8, but they've told us it's 92. By the time we start the loan, I've just said interest rates could be different. And of course, automatically the futures price will be different. If the interest rates turns out to be 10%, the futures price will have gone down to 90. If the interest rate's 6%, the futures price will have gone up to 94. Well, if we're using futures, as of today, all we do, we leave the transaction at risk, so leave the loan at risk. As you'll see, we end up paying whatever the interest happens to be. But to cancel any gains, losses, we'll start a futures deal. And what will our deal be? Think back, or look back to what I said shortly ago, that because I'm worried about the interest going up, we'll pay more interest, and if interest goes up, the futures price will go down. And so our futures deal, we will sell futures. How much? We're at risk on 6 million. Sell 6 million futures at today's price of 92. However, I've got a problem. And the problem is this, and listen very carefully, and then I'll give you the rule. if interest rates go up by, let's say, 1%, we're borrowing 6 million for 6 months, and therefore the extra interest we'll pay will be 0.6%. If it goes up by 1% per annum, then because the loan is for 6 months, instead of paying 8% for 6 months, we'd pay 9% for 6 months. And therefore, it'll be 1%, 6/12. It'll be half of 1%. But the problem we've got with these futures is I told you a few minutes ago that if the interest rate goes up by 1%, the futures price would go down by 1. But when we calculate the profit on futures, it's always the difference. If it goes down by 1, the difference is 1, divided by 400. We do it as a percent, but it's always calculated for 3 months. They're 3-month futures, always. And so gives us a big problem, surely. If interest rates go up, on the loan itself, it'll be half a year at 1%. The futures, they'll go down by 1%, but the profit is calculated as a quarter of a year at 1%. And so the two aren't going to cancel. Half a year at 1% on the loan is not going to match with a quarter of a year at 1% on the futures. And so what we're going to have to do is this. We're going to have to gamble on more futures. And in fact, the futures, I'll write it as a rule, but then rather than keep talking, I'll show you with the example and you'll see how it works. Always the futures will be the amount of the loan However, because we're at risk for the number of months of the loan, and yet futures only protect us for 3 months, we'll multiply by 6/3, where 6, if I can find the colour, is the length of the loan. Here we're borrowing for 6 months, so on the top is 6. Divided by 3, well, it's always 3 because they're 3-month futures. Now, as I say, to some of you, what I said before may already have made sense of that. But if you're still a bit confused, if we now look properly at example 3, you'll see, hopefully, exactly why we need that rule. But the futures we deal in, I hope it's clear why we sell. We're borrowing money, so we'll sell futures. And if rates go up, they'll make a profit to compensate for the extra interest. But when you're calculating how many futures we sell, it's always the amount of the loan, here 6 million, multiplied by the length of the loan divided by 3. All right, so let's carry on now the question and let's make sense of it. That's all we'll do today. The loan we simply leave at risk. When we take the loan, we'll pay whatever the interest happens to be. But we'll start a futures deal, we'll ring the dealer and we'll say, sell. What does this come to? 6/12, 6/3 times 6. We'll tell the dealer we want to sell 12 million futures at 92. Remember, it's just a phone call. Although there'll be a deposit payable, a margin, we ignore that in our arithmetic. We just ring up and say, sell 12 million. Later we'll have to buy 12 million, and it's only at the end we'll settle up. I'll get paid any profit, we'll pay in any loss. We then wait until the start of the loan. Here, the 1st of January. And when we start the loan, look at the question. It says, assume on the 1st of January, the interest rate has changed to 10% per annum. And of course, if the interest rates change, the futures price will have changed. And it's changed to 90, which is perfect, isn't it? 100 minus 10, the futures price is 90. And now let's sort out what happens. First of all, the loan itself. We left the loan at risk and we pay whatever the interest happens to be, whether it's higher or whether it's lower. So the loan was 6 million. The actual interest is 10%. But the interest, always yearly, quoted yearly, but we're only borrowing for 6 months, so 6/12. And so we'll pay interest of 300,000. So the loans left at risk pay the actual interest, but we then close our futures deal and we'll make a gain or a loss on the futures. And what will the gain or loss be? Well, we were dealing with 12 million futures. And to calculate the gain or loss, we always take the difference between the sell and the buy price. So here we sold futures on the 3rd of October when the price was 92. We close the deal at the start of the loan, so we buy back the futures when the price is 90. And the gain or loss, as I said, is always the difference between the sell and the buy. It's always divided by 400. And so how much would that be? Well, first of all, it'll be a gain, obviously. We're selling at a higher price. 92 minus 90, the 2%, divide by 400, as applied to 12 million, is 60,000. It's a gain, so there's a receipt of 60, and therefore the net cost 240,000. So arithmetically, I hope that's clear. But what effective rate have we ended up paying? We've ended up paying a net 240,000 on a loan of 6 million. But that's over a 6-month period. And so to turn it into a 12-month effective rate, multiply by 12 over 6. And we're effectively paying %8 per annum, which is today's rate. You see, at the moment, interest rates are 8%. If we had been taking the loan today, we'll have paid 8%. We weren't taking the loan today, we were waiting several months, October to January, whatever it is. And when we actually came to take the loan, on the loan, we had to pay 2% more. We were paying 10%. We paid 300, we've lost out on the loan. But we've got the compensating gain on the futures, 60,000. We have effectively fixed it at 8%. So, I mean, that's the baby example. Things don't work so perfectly in real life or in the exam. But I hope I've made it clear what's happening. Just like foreign exchange risk, we leave the transaction at risk and pay the actual interest, and we've got the compensating profit or loss on the futures. But I hope it's now clear why, given that the loan was for 6 months, and so we're at risk of 6 months interest, but the futures, the gain is only calculated for 3 months because they're 3-month futures. Why it is that the futures deal, we gambled on 12 million. It was a 6 million loan. Futures protect us for 3 months. We need protecting for 6 months, so we needed twice as many futures. However, there we are. And of course, I won't waste your time, but interest rates could have gone either way. You know, if interest rates had gone down, we'd have paid less on the loan, 8%, 7%, whatever. But on the futures, you'd have made a loss, because if interest rates had gone down, the futures price would have gone up. We'd have made a loss on the futures. The net effect, though, try a different interest rate and you'll see that whatever happens on this question, we'd be paying a net 240. We'd have fixed it effectively at 8% whatever happened. So with futures, the overall result, you neither gain nor lose, whichever way interest rates go. Using futures effectively fixes the interest rate. All right, that was a baby example. And the problem in real life and in the exam, well, there are 2 of them, but the same problems as we had for foreign exchange risk. The problems are twofold. Firstly, you can only deal in futures in fixed size contracts. You'll be told the contract size in the exam, but because of that, you may not be able to deal in the exact number of futures that we need. It'll be a bit more, a bit less. And secondly, just as with foreign exchange futures, although futures prices do move with the interest rate, they're not exactly the same. There is this basis. Futures prices do not exactly equal the equivalent interest rate. They are 2 different things. And although, you see, this was a baby example, although at the moment interest rates are 8% and the futures price was 100 minus 8, it was 92. In real life, it wouldn't be exactly 92. Oh, it might be 91.85 or something. And okay, as interest rates go up, the futures price will go down, but day by day, the 2 won't exactly equate to each other. And so there are those 2 extra problems. And for that reason, we won't end up having what you might call a perfect hedge. But that's the same problem as we had anyway. So, yet again, I'll stop this lecture, but in the next lecture, we'll go through a full exam standard type question with those problems in.